In the last 24 hours, 4 separate alarms went off at the exact same time. Washington signaled a price floor framework for critical minerals. America's biggest primary silver miner revealed buyers are paying far above the official benchmark. The largest online bullion dealer admitted the physical pipeline just jammed for weeks. And a wall of in-the-money March call options is now aimed straight at the delivery window. That is what happened. And if you only watched the chart, if you only saw silver recovering, you missed the real story. The paper price is losing authority, and the people who actually need metal are building a parallel pricing system right under the bank's noses. Welcome back. This is the hidden economy. If you want the updates the financial media won't connect for you, hit subscribe now. Quick, 1 click, done. Now let's move because the calendar matters here. Everyone wants to argue whether silver deserved to crash, whether the rally broke, whether the move was a bubble. That's the distraction. The real question is simpler and more dangerous. Who is setting the price now? Is it the exchange and the paper casino? Or is it governments writing policy, miners selling directly, and industrial buyers paying whatever it takes to secure the atom? Because the last day gave us 4 signals from 4 corners of the system, and all 4 point the same way. The floor is being built. The premium is already here. The bottleneck is real, and the delivery math is tightening. Let's start with the part that changes everything, the floor. Most people hear critical minerals and their eyes glaze over. They think it's a boring trade memo. They scroll. Don't scroll. A price floor is a declaration of intent. It's the state saying, this cannot be allowed to trade below a strategic threshold. You don't build a floor unless you believe the market price is wrong. You don't ask allies to coordinate unless you believe pricing is being distorted. And you don't do it right after a historic crash unless you think the crash exposed a vulnerability. A floor is an admission. It's the government admitting the free market price is failing to secure supply. And in commodities, when supply becomes national security, price discovery becomes politics. Now don't romanticize this. Policy is messy. It gets delayed. It gets diluted. It gets buried under headlines. But policy tells you what powerful institutions are afraid of. Right now, they are afraid of critical mineral scarcity. That's why they're talking about reference prices across stages of production. That's why they're talking about tariffs that adjust to uphold integrity. That's why they're talking about reserves and coordinated blocks. It's control, dressed up as stability. And here's the detail you need to sit with. A floor is not designed for speculators. It is designed for builders. It's designed for the factories that need predictable inputs. It's designed for the defense supply chain that can't afford shortages. It's designed for the energy transition that burns through metals the public barely understands. So when you see a floor conversation, it's the system quietly confessing, we can't keep pretending this is just another commodity. Now, why does that matter for silver specifically? Because silver is not a niche metal anymore. Silver is embedded inside solar, semiconductors, power electronics, advanced contacts, medical hardware, and defense systems. Silver is the silent conductor of the modern world. If you want electrification, you want silver. If you want grid resilience, you want silver. If you want high reliability systems, you want silver. So when the floor framework appears for critical minerals, silver is in that conversation whether the headline spells it out or not. And a floor does something else the average investor hasn't processed. It changes the risk profile. Even a soft backstop tells capital, the downside is politically unacceptable. That invites accumulation. That invites financing. That invites miners to spend money again. And that is toxic to a paper market that depends on weak hands and short attention spans. Because if downside is defended, the old manipulation playbook gets harder. Volatility still happens. Smashes still happen. Fear still happens. But the market starts to treat those smashes like coupons. Now pivot to the second pillar, the miner premium. Governments can talk all day. Miners file numbers. And numbers are where reality leaks out. America's largest primary silver producer just posted the kind of year you only see when the system reprices around you. Revenues up, profits exploding. The kind of results that make you realize the crash wasn't the end of anything. It was a violent reset inside a much larger cycle. But the detail that matters wasn't the headline earnings. It was the realized silver price. Their realized price came in far above the benchmark price most people watch. Not by a cute little error, by a premium big enough to force a hard question. How does a miner sell above the market price? Either they got lucky with timing, or they negotiated direct contracts with embedded premiums for form, delivery, and certainty. Or the benchmark is no longer the market. It's a reference point, a suggestion, a scoreboard from a different game. In a world where buyers fear delivery risk, they pay for certainty. They bypass the exchange. They bypass the roulette wheel. They go straight to the source and they pay up. Because the exchange price is cheap only if you can actually get the metal. If you can't, then cheap is fiction. And that premium isn't just bullish, it's diagnostic. It's a symptom of a market splitting in two. A paper price for traders, a physical price for users. The paper price is loud. It flashes red and green. It tries to control your emotions. The physical price is quieter. It shows up in realized numbers, procurement deals, lease rates, and inventory behavior. But the physical price is the one that matters when you're building factories. Now look at what miners are doing with capital. They are trimming distractions. They are selling non-core assets. They are choosing silver over safer diversification. They are increasing spend aimed at future ounces. Ask yourself why. If silver was done, why would a century-scale miner increase exposure? Because the people closest to the metal see the shortage coming before the chart does. And the cost structure is the giveaway. When all-in costs sit in the teens and realized prices are dramatically higher, you don't need a PhD to see what happens next. Margins expand, cash piles up, debt melts away, exploration becomes mandatory. Because in a tight market, ounces in the ground are not just inventory, they are leverage. And leverage attracts the most aggressive buyers on earth, the industrial users who cannot miss shipments. Here's the part the mainstream ignores. When miners report realized prices above benchmarks, it means the real market is happening off-screen. And off-screen markets don't care about the daily candle. They care about supply assurance. They care about multi-year contracts. They care about direct offtake. And once those contracts are signed, that metal is gone. Not gone like a trader sold it, gone like it is allocated before it ever hits a warehouse report. That is how shortages become visible, not at first in price, first in allocation. Now pillar 3, the retail bottleneck. This one is personal for anyone who buys physical. The largest online bullion dealer in America just told customers shipping times are back to normal. That sounds comforting. It's also a confession. CEOs don't write letters to say, "We're normal again," unless something was very not normal. And what went wrong wasn't a website glitch. It was the physical pipeline. Orders exploded. Inventories thinned. Fulfillment windows stretched. Customer service loads spiked. Product menus narrowed because you can't sell what you can't restock. That's not a little surge. That's a stress test. And it revealed something analysts hate to admit. Retail still matters. Retail is the visible tremor that tells you when the public starts competing for the same ounces industry wants. Retail is the smoke alarm. The factory buyers are the fire. And the dealer letter was the smoke alarm screaming through the wall. Now the key question is not, are they caught up today? The key question is, why did they catch up? Did the world suddenly produce more metal? Did refineries suddenly triple output? Did the structural deficit vanish? Or did the crash scare enough people away, temporarily, long enough for backlogs to clear? You already know. A crash doesn't fix supply. It shocks demand. It buys time. So what happens when demand returns? You get the same bottleneck, but worse because inventories are lower. This is the cycle nobody wants to say out loud. Price runs, demand surges, pipelines jam, premiums rise. Then price gets smashed, demand pauses, dealers catch up. Then price runs again. And each cycle leaves the system more fragile because the metal doesn't magically replenish. It gets absorbed and locked into products. So when a dealer tells you, "We're back," don't hear comfort, hear warning. Because back is a short pause between waves. And if you've ever watched this market in real time, you know what happens when the next wave starts. The shelves don't empty slowly, they empty overnight. Now pillar 4, the options wall. A huge number of March silver call options are in the money right now. Historically, banks try to shove price down into expiry to kill as many calls as possible. That's why you see mysterious smashes into key windows. The goal is simple: make profitable calls die before they can be exercised. But here's the problem for the shorts. Even after the recent slam, a mountain of calls stayed alive. And as price climbed back, more came back into profit. Now, options don't automatically mean delivery. most settle in cash. But in a market where physical premiums are wide, where direct mine supply is being bid up, and where the retail pipeline just proved it can jam, the incentive structure changes. Because now exercising can become more than a trade. It can become an arbitrage. Paper exposure can be converted into delivery pressure, and the closer you get to first notice day, the more the market has to face the question it hates. How much metal is really available? Not how many contracts exist. How many ounces can actually be delivered without breaking confidence? This is where people throw around vault categories like they're magic words. Registered, eligible, total. But the truth is simpler than the spreadsheets. The system works as long as enough people choose cash. If too many want bars, the math becomes political. And that loops you right back to the floor conversation. States don't build floors for markets they think are stable. They build floors for markets they fear could fracture under stress. Now step back and connect all four signals. Policy, a floor framework taking shape. Mining, realized prices printing a premium. Retail, a public admission that fulfillment broke under demand. Derivatives, a live option structure approaching the window where paper promises meet physical bars. Four angles, one conclusion. The paper price is losing its monopoly. And you can see the replacement forming. It looks like reference prices, tariffs, and reserves on one side. It looks like premiums, direct contracts, and bypassed exchanges on the other. And it looks like delivery pressure testing the edges. This is not silver is bouncing. This is silver is being reclassified from a trade to a strategic input. Now let's talk about what comes next, because this is where retention lives. Over the next days, you're going to see two forces fight. Force 1, the old system. The old system uses volatility as a weapon. It uses narrative as a weapon. It uses your emotions as a weapon. It tries to convince you that a smash means the story is dead. Force 2, the new system. The new system is made of procurement contracts, stockpiles, and premiums. It doesn't care about headlines. It cares about shipments. It cares about schedules. It cares about engineering deadlines that don't move because a chart moved. So here are the scenarios. Scenario A, another smash. If they slam price again into the key window, they might kill some calls and scare some retail. But here's the catch. Every smash that fails to fix premiums makes the physical market louder. Every smash that fails to refill pipelines makes dealers more cautious. Every smash that fails to loosen mine gate premiums encourages direct offtake. So if they smash, they may win a day and lose the cycle. Scenario B, controlled grind higher. If price keeps grinding, more calls stay alive. That keeps pressure on the paper side. And the closer the market gets to the delivery window with a large option structure intact, the more the system has to pay attention to physical constraints. Scenario C, policy acceleration. If the floor framework turns into real enforcement, it changes behavior immediately. Miners invest faster. Industrial buyers lock supply faster. Speculators re-enter faster because a backstop changes psychology, and psychology is half the market. Here's the cliffhanger. We are approaching a moment where paper, physical, and policy collide. And when those three collide, something gives. Either the paper market reasserts dominance with another violent smash, or the physical market forces repricing through premiums and delivery pressure. Or policy steps in harder to stabilize, which is a polite word for controlling access. And none of those outcomes are bearish for physical holders over a full cycle. Volatility is scary. Volatility is also how transfers happen. Now I'm going to say something that will make some people uncomfortable. The mainstream financial media is not missing this. They are selecting what to show you. Because if the average viewer understood that miners are realizing higher prices than the benchmark, it would reveal the benchmark's weakness. If the average viewer understood that dealer fulfillment can break under demand, it would reveal how thin the pipeline is. If the average viewer understood that a state is discussing floors and reserves, it would reveal the strategic nature of the metal. And once people see a metal as strategic, they don't treat dips like danger. They treat dips like opportunity. That's why the story gets minimized. That's why it gets fragmented into 4 separate headlines that never get stitched together. But stitched together, it's obvious. A floor being discussed, a premium being paid, a bottleneck being exposed, a delivery window being approached with live options pressure. That is not a normal market. That is a market transitioning into a different regime. One last thing, because timing is the entire game. We are not talking about sometime this year. We are talking about the next week and the next notice window. When you're this close to a key date, price is not just price, it's positioning. Every dollar up pulls more calls into profit. Every dollar down is an attempt to save the short side. And the physical market is watching, because if paper drops while premiums stay sticky, buyers learn the trick. Buy the discount, demand the metal, and let the spread pay you. So watch the simple tells. If spot dips but dealers don't lower premiums, the dip is paper. If miners keep realizing prices above benchmark, the benchmark is paper. If delivery chatter rises into the window, the paper promise is being tested. And if policy language keeps hardening around floors, reserves, and integrity, the state is telling you the metal is strategic. This is why the next move can be violent. Not because silver is mystical, because the system is being forced to reconcile two different prices for the same element. Paper wants a number. Physics wants a shipment. Physics eventually wins. Now, two quick questions for you because I want your read. Do you think a government-backed floor, even a soft one, ends the era of cheap silver forever? And if you had to pick, what breaks first? The paper discount, the dealer pipeline, or vault confidence? Drop your answers in the comments. I read them, and the sharpest takes shape what we cover next. Now, don't fall into the emotional trap. They want you exhausted. They want you staring at hourly candles. They want you addicted to panic and relief. Detach from the noise and watch the signals that matter. Watch premiums. Watch delivery behavior. Watch mine-realized pricing. Watch policy language. Because you can crash a price on a screen. You can flood a market with contracts. You can spook retail for a few weeks. But you cannot print atoms. You cannot speedrun new mines. You cannot pretend a strategic mineral is optional once governments, manufacturers, and miners all start behaving like it's essential. The floor is being built, and silver is standing on it. If this helped, subscribe. Short and simple. You'll want the next update before it hits the headline cycle. And share this with one person who still thinks spot price is the whole story. Because the spot price is becoming the least important number in the room.